How to invest $1,000 and actually double it for beginners. Hey stars, my name is Jake Williams, e-commerce and tech entrepreneur. Today I'm going to share the truth on how doubling your money is actually possible using the stock market by investing in index funds, specifically the S&P 500. And if you attempt to do this, the pros and cons to using this methodology. We're going to cover this in 3 sections. Number 1, what is the S&P index? Number 2, is the S&P a safe investment with a high return? Number 3, how we can use the S&P to turn $1,000 into $2,000. First things first, if you're a beginner, what are you most likely to invest in? Well, the S&P 500 probably. After all, it's one of the most popular investment indexes in the world. And that's why we cover it in this video. If you're not sure what the S&P 500 is, that's why I'm here. At InvestSTARS, we explain things simply for your educational investment journey. And if you enjoy learning through smart investing made simple techniques, be sure to visit our website and check out our free guides on investing and trading. So, what is the S&P 500 index? The S&P 500 tracks the stock performance of the 500 largest companies listed on the stock exchanges in the United States. These companies are selected based on their market capitalization. Wait, what? What's market capitalization? What does that even mean? Market capitalization is the value of a company that is traded on the stock market, calculated by multiplying the total number of shares by the present share price. For example, if Apple has 10 shares at $10 each, its market capitalization would be $100. Importantly, the S&P 500 is a market cap weighted index, which means that companies with the largest market capitalizations have the most influence on the index's performance, as they are most weighted within it. Let's look at an example. Say the total market cap of the S&P is $1,000 and Apple's worth is $100. That would mean that Apple's weight would be 10% of the overall index. While if Google's worth was $50, then their weight would be 5%. If Apple and Google had a terrible day on the markets and they both lost 10% of their stock price, Apple's weighting would have a larger impact on the overall S&P, as its weight of 10% is larger than Google's 5%. While this example is fictional, and Apple and Google are certainly not worth these sums of money, and these aren't the correct weightings, they are both on the S&P index. So are other companies such as Meta, Hess Corp, and Berkshire Hathaway. As you can probably tell from this short list, the S&P 500 is a broad-based index, which means it covers a wide range of industries. The 500 companies in the index represent a variety of sectors, including technology, healthcare, finance, consumer goods, and industrials. This makes the S&P a good proxy for the overall performance of the US stock market. The S&P 500 is one of the most popular investment indexes in the world. It is also used by many investors as a benchmark for their investing performance. Can you think of anyone who outperforms the S&P on a regular basis? That's an interesting debate and question, and we'll cover that in a different video. Make sure you subscribe to catch it. Now, if you're wondering the best way to invest in the S&P, it's widely considered that using an ETF is a cheap and effective way. An example of an ETF that tracks the S&P would be the Vanguard S&P 500 ETF. And if you're not sure what ETFs are and how they work, check out our free guide on ETFs in the description. In the description, you'll also find a review of different investment platforms that offer ETFs as an investment option. Check them out and make sure you choose the best one that is suited to your requirements. So, is the S&P a safe investment with a high return? In reality, no investments are 100% safe. They all go up and down over different periods of time, but when you invest in an index fund such as the S&P, which tracks such a wide range of companies and industries, you are diversifying your investments. You haven't just put all your eggs into one basket. The S&P is made of 500 different companies that it tracks based on their market cap. Diversification is really important. You'll see me talk about this in all of our videos. Why? Because it allows you to mitigate risk. How? You don't want to be too exposed to any one particular industry or stock, as this may result in a major loss that is hard to recover from. Let's look at this idea of diversification a bit more deeply. While investments go up and down, the historical returns of the S&P has shown to grow on average 10% per year in the last 10 years. This is pretty impressive. However, it's important to note that these are just average returns. The actual return of the S&P in any given year can vary significantly. For example, the S&P lost 37% in the 2008 financial crisis and 18% in the 2022 bear market. But if we compare these losses to an individual stock as a case example, let's choose Meta. This stock was down 65% in 2022, and it's much better to me to be down 18% in comparison to 65%. I'm sure you'll agree. The reason why the S&P lost less is because the S&P tracks 500 stocks and not just one. Therefore, the winners in these 500 companies balance the losses. For example, Hess Corp stock, which is also in the S&P, grew an outstanding 94% in 2022. This is one of the stocks that resulted in the S&P evening out its losses. So I hope we outlined here clearly the power of diversification and its important relation to risk management, protecting your gains and limiting your losses. If you want to learn more about risk management, we have a free guide on it on our website. Feel free to check it out. So, how do we turn $1,000 into $2,000 by investing in the S&P? Simple. Compound interest. Wait, what's compound interest? Compound interest is the interest earned on both the initial amount you invested and the interest that has already been earned. This means that the interest you earn each year gets larger and larger as the investment grows. Let's look at a practical example. If we invest $1,000 in the S&P and it makes 10% per year, then in 7.27 years, we would have doubled our investment to get to $2,000. Here's the math. In the first year, you will start with $1,000 with an interest of 10%, so you'll end up with $1,100. In the second year, you'll start with $1,100 with an interest of 10%, which becomes $1,210. The third year, you'll start with $1,210, interest 10%, you end up with $1,331. By the seventh year, you'll have $1,771 with an interest of $177, and you end up with $1,948. Not exactly $2,000, but pretty close. This may seem like a long time to new investors, but long-term investing is about growing wealth over time. It's not about getting rich quick. So this is a potential and realistic scenario of how you can double your money using the S&P 500, how long it takes, and the actual risks involved. And these are real. If you're looking for quicker returns, our next video is going to talk about trading versus investing, and if day traders do actually make more money than investors. Make sure you subscribe to get the first release of it. If you've enjoyed this video and want to learn more about investing, we recommend that you check out our website, investstars.co.uk, and read our long-term investment guides. See you soon, stars.